Hey everyone, welcome back to the channel. Today we're diving into the exciting world of investing in the stock market. We'll explore how emotions like greed and fear drive market behavior and how you can use them to your advantage. The stock market is fundamentally driven by two powerful emotions, greed and fear, that influence investor behavior and market trends. These emotions, often irrational, can cause wild fluctuations in stock prices, creating both risks and opportunities for investors. Greed comes into play when the market is rising and people start to believe they can make quick profits. As more investors rush to buy into the market, often without considering the actual value of the stocks, prices get driven up. This is commonly seen during market bubbles, where prices rise far beyond what the companies are actually worth, driven solely by the optimism and speculative behavior of investors. People see others making money and fear missing out, leading to a frenzy of buying. On the flip side, fear emerges when market conditions worsen, whether due to economic downturns, geopolitical events, or global crises. Investors panic at the thought of losing money, which leads to a massive sell-off. This is what we saw during events like the 2008 financial crisis or the COVID-19 pandemic. Stock prices plummet as investors rush to sell, often disregarding the long-term value of the companies. Fear causes people to overreact, leading to steep declines in the market. Understanding how greed and fear drive the market is crucial for making strategic investment decisions. When most investors are acting out of greed, prices are often inflated, and this is when savvy investors might decide to step back and avoid overpaying for stocks. On the other hand, when fear dominates and everyone is selling in a panic, prices fall well below the intrinsic value of companies. This is where the true opportunities lie. By keeping a cool head and recognizing these emotional cycles, you can position yourself to buy low when others are selling out of fear and sell high when the market is driven by greed. In essence, mastering these emotional dynamics allows you to make decisions that are not driven by the crowd, but by a long-term, rational strategy. Warren Buffett, widely regarded as one of the greatest investors of all time, often emphasizes the importance of staying within your circle of competence. This principle means focusing on investing in businesses or industries that you truly understand, those in which you have enough knowledge to make informed and rational decisions. By adhering to this strategy, you can significantly reduce risk and improve your chances of making profitable investments. When you invest in areas you understand well, you're better equipped to evaluate a company's performance, its business model, and its long-term prospects. This allows you to spot real value and distinguish between a temporary dip in stock price and a sign of deeper underlying issues. It also helps you stay clear of hype and speculative bubbles. Many investors fall into the trap of chasing the latest market trends, whether it's in tech, cryptocurrency, or other hot sectors they may not fully comprehend. This kind of blind following of trends often leads to poor decision-making, as investors become overly reliant on market sentiment rather than a solid understanding of the business itself. For example, if you work in the healthcare industry or are familiar with it, you might focus on investing in pharmaceutical companies or healthcare technology businesses. Your deeper knowledge of how these companies operate, their challenges and opportunities, allows you to better predict their long-term success. Conversely, if you were to invest in a sector like renewable energy without understanding its intricacies, you might fall victim to market volatility and trends without grasping the fundamental drivers of growth in that industry. Buffett's advice is about playing to your strengths. If you invest within your circle of competence, you can avoid common pitfalls like overreacting to short-term market movements or getting swayed by market hype. Instead, you make decisions based on solid research, your expertise, and a long-term outlook, giving you a significant edge over those who rely on speculation. The concept of buying stocks when the market is on sale refers to purchasing shares during times of economic downturn or crisis when stock prices have plummeted. These are moments of widespread fear and panic, like during the 2008 financial crisis or the COVID-19 pandemic, when investors rushed to sell off their stocks, leading to sharp declines in market prices. During these times, many stocks, often including solid, well-established companies, are undervalued because investors are more concerned with getting out of the market to avoid losses. However, these short-term dips don't necessarily reflect the actual strength or long-term potential of these businesses. In fact, the fundamentals of many companies remain strong, But because of the broader panic, their stock prices fall well below their true value. This is where the opportunity lies. Buying during these periods of crisis allows you to acquire stocks at a deep discount. Historically, markets have shown a strong tendency to recover over time, even after severe downturns. Once the panic subsides and economic stability begins to return, stock prices often rebound, sometimes dramatically. If you had purchased shares during the 2008 crash or at the height of the COVID-19 sell-off and held onto them, you'd have likely seen significant gains as the market recovered. For instance, during the COVID-19 pandemic, major companies like Amazon, Apple, and Tesla experienced sharp declines, but within a year or two, their stock prices surged to new heights. This underscores the importance of staying calm during times of crisis, recognizing the long-term potential of strong businesses, and seizing the opportunity when the market offers these sales. The key is to have the courage to act when others are paralyzed by fear. As the saying goes, be fearful when others are greedy, and greedy when others are fearful. By buying when the market is in turmoil, you position yourself for strong returns when the market inevitably recovers. Value investing is a strategy where investors seek out stocks that are undervalued by the market but have strong fundamentals, meaning the company's financial health, business model, and long-term growth potential are solid, even if its stock price is currently lower than it should be. The core belief behind value investing is that the market often misprices stocks due to short-term factors like fear, uncertainty, or temporary issues. Over time, however, the market tends to correct itself, and stocks return to their true intrinsic value. During times of crisis like the COVID-19 market crash, many companies, despite their solid performance histories, saw their stock prices plummet. This sharp decline wasn't necessarily a reflection of the company's actual worth, but rather a result of the overwhelming panic that gripped the market. Value investors saw this as an opportunity. Instead of joining the panic-selling crowd, they identified strong, resilient companies that were temporarily undervalued. Take Amazon and Disney as examples. When the pandemic hit, Amazon's stock fell sharply as fears of a global economic downturn took over. Yet value investors recognized that Amazon, with its massive e-commerce infrastructure and cloud services, was not only well-positioned to survive the crisis, but also to thrive in the new stay-at-home economy. Indeed, as people began shopping online more than ever, Amazon rebounded quickly and its stock soared. Similarly, Disney, a company with a strong brand and diverse revenue streams, from theme parks to media and streaming, was hit hard because its theme parks had to close and movie releases were delayed. But value investors understood that Disney's fundamentals remained solid. With its successful foray into streaming through Disney Plus, coupled with the eventual reopening of its parks, the company was bound to bounce back. As expected, Disney rebounded as the world began adjusting to the new normal, and its stock surged. The key element in value investing is patience. Unlike other investing strategies that focus on short-term gains or following market trends, value investing requires a long-term perspective. It takes time for the market to recognize the true value of these undervalued stocks and for their prices to recover or even surpass their pre-crisis levels. Investors who bought Amazon, Disney, and similar companies during the COVID-19 crash had to wait patiently, but the rewards for doing so were substantial as the market recovered, and these stocks rose significantly. This approach requires not only a keen eye for identifying undervalued opportunities, but also the discipline to hold on to these stocks during periods of market volatility and uncertainty. Value investors understand that the market often overreacts in the short term, but companies with strong fundamentals will recover, and their stock prices will eventually reflect their true value. This patience is what separates successful value investors from those who are swayed by fear and panic during downturns. In summary, value investing is about finding great companies that are temporarily out of favor with the market, buying their stocks at a discount, and holding on for the long term. The COVID-19 crash provided a clear example of how patience, combined with a focus on strong fundamentals, can lead to significant gains when the market rebounds. During the COVID-19 crisis, we saw massive sell-offs across global stock markets as fear gripped investors. Even top-performing companies like Apple and Tesla, which had strong fundamentals and long-term growth potential, were not immune to the panic. Their stock prices dropped significantly as investors rushed to liquidate their holdings, driven by fear of economic uncertainty and a potential global recession. However, this widespread panic created a rare opportunity for those who follow a contrarian investing strategy. Contrarian investing involves going against the prevailing market sentiment. When most investors are selling out of fear, contrarians step in to buy. They understand that the market often overreacts during times of crisis and that solid companies with strong track records, like Apple and Tesla, are likely to bounce back once the crisis subsides. For example, during the initial months of the COVID-19 pandemic in early 2020, Apple's stock price fell by over 20%. Yet those who recognize the company's dominance in consumer technology, its innovation pipeline, and its loyal customer base knew this was a temporary dip. By buying Apple stock during the downturn and holding onto it, investors saw its price recover and even surge to all-time highs, resulting in substantial gains. Similarly, Tesla, a leader in electric vehicles and renewable energy, saw its stock price drop sharply in early 2020. Despite short-term challenges, contrarian investors understood Tesla's long-term vision, its strong position in a growing industry, and its potential for innovation. Those who bought Tesla during the pandemic's market crash were rewarded as the company's stock price skyrocketed in the following years. This highlights the core principle of contrarian investing, buying when others are fearful and selling when others are greedy. While it can be difficult to go against the crowd, especially during times of widespread uncertainty, history has shown that those who take calculated risks during downturns often reap the rewards when the market recovers. The COVID-19 crisis serves as a perfect example of how market panic can create opportunities for savvy investors. If you had invested in companies like Apple and Tesla during the sell-off and held on to those stocks, your portfolio would have seen substantial returns as the market rebounded. This approach requires not only a strong understanding of the underlying value of companies, but also the patience and courage to stay invested during periods of volatility. Dollar cost averaging, DCA, is one of the simplest yet most effective strategies for building long-term wealth, especially for investors who are patient, consistent, and looking to avoid the emotional roller coaster of market fluctuations. The basic idea is straightforward. Rather than trying to time the market by buying stocks when you think prices are low, which is incredibly difficult to do consistently, you invest a fixed amount of money at regular intervals, regardless of whether the market is going up or down. Here's how it works in practice. Imagine you decide to invest $500 every month in an index fund like the Vanguard S&P 500. Some months the market might be soaring and your $500 will buy fewer shares because the prices are high. Other months, the market might be in decline and your $500 will buy more shares because prices are lower. Over time, this approach smooths out market volatility because you're buying more shares when prices are low and fewer when prices are high. One of the biggest advantages of dollar cost averaging is that it helps investors avoid panic selling. When markets crash, many people get scared and sell off their investments at a loss. But if you're committed to DCA, you'll keep investing regularly, even during downturns. This not only keeps you from making emotional decisions based on fear, but it also allows you to take advantage of market dips, buying more shares at lower prices and positioning yourself for future gains when the market recovers. Dollar cost averaging also fosters discipline and consistency. By investing a set amount at regular intervals, you build the habit of investing, which helps you steadily accumulate wealth over time. It takes the guesswork out of when to invest and eliminates the temptation to chase hot stocks or get caught up in market hype. This strategy is particularly effective in the long run, where market fluctuations tend to even out and the overall trajectory of the stock market is upward. Historical data shows that over extended periods, broad market indices like the S&P 500 have delivered steady growth despite short-term volatility. By consistently investing in these indices, you can grow your wealth slowly and safely, without the need for market timing or speculative trading. While Warren Buffett himself has said that this method is not necessarily true investing in the sense of picking individual stocks, he has acknowledged that it's a solid strategy for most people looking to build wealth. This is because it's simple, requires no special knowledge of the market, and removes the emotional element that often leads investors astray. In summary, dollar cost averaging is ideal for those who have the stomach for patience and consistency. It's not a get-rich-quick scheme, but it's a tried-and-true method for building wealth slowly over time. If you stick with it and continue investing through both good times and bad, the compounding effect of your investments will create substantial growth, helping you achieve financial security and long-term wealth. To wrap up, remember that investing is a marathon, not a sprint. Whether you're following a value investing strategy or utilizing dollar-cost averaging, the key to building wealth is patience and persistence. Stay disciplined, keep your focus on the long term, and don't let short-term emotions like fear or greed dictate your decisions. Markets will always have ups and downs, but by sticking to a solid strategy and investing consistently, you'll position yourself for steady growth over time. Thanks for watching, and if you found this video helpful, make sure to like, subscribe, and hit the notification bell for more insights and tips on investing. Happy investing!